The announcement that the Trump administration might apply country-specific U.S. tariffs to 1 kilogram gold bars triggered an immediate shift in market dynamics, altering price movements and disrupting global trade flows within moments. Simultaneously, as U.S. futures contracts soared to new peaks, spot market prices trailed behind, causing the trading spread to widen significantly. Reports of a potential 39% tariff on Swiss gold gained momentum, with the future spot differential in dollars creating a surge that reached nearly 100 on trading screens throughout the day. Refineries and logistics firms adopted a cautious stance, pausing operations, while shipping teams halted transport plans due to unclear U.S. customs classification language, prompting a swift market response. The core challenge was determining which bars fell under which tariff categories, and the trade network remained unsettled until Washington provided clear guidance. This initial frenzy eventually settled into a partial balance. Why focus on 1 kilogram bars? Liquidity, purity, and deliverability. Yet, the market continues to await a formal document outlining the effective date, scope, and exemptions, closely tracking the timeline of any U.S. statement. The rapid market reaction stemmed from gold's dual role as both a financial asset and a critical component in trade logistics, creating immediate pressure on supply chains. The growing divide between futures and spot prices emerged from uncertainties about the physical delivery routes for bars used in U.S. contracts, dampening the confidence of arbitrage traders. If a bar category unexpectedly faces U.S. tariffs, it delays anticipated shipments in the trade chain, directly impacting market prices. At this stage, arbitrageurs reassess the buy-transport deliver process, factoring in trade costs and adding a U.S. risk premium to their calculations. Though this process seems straightforward, it disrupts economic stability by introducing sudden costs and delays. Futures versus spot. How unclear wording fuels price gaps. In essence, the future spot spread widens when logistical bottlenecks form on the U.S. side, compounded by added risks like storage, insurance, and transportation uncertainties. This explains why price swings occur, not only from demand shifts, but also from ambiguous tariff language, with markets stabilizing through clear procedures rather than panic. The situation reveals that what seems like a simple tax on bars is, in reality, a test of confidence in the U.S. financial system. Refineries felt the initial impact through disrupted shipping schedules and opted for a wait-for-clarity approach in response to U.S. customs rulings. This choice, while significant, carries weight because even a brief delay can shift delivery timelines and trade flows. While jewelry retailers swiftly adjusted their pricing to align with U.S. retail trends, industries reliant on alloys and components for production adopted a more reserved strategy. The logistics bottleneck, storage, insurance, and transport risks. Electronics manufacturers, who depend on gold for plating and connectors, evaluate trade, lead times, and explore alternative suppliers if U.S. delays arise. Even if new sources are secured, tariff risks in other countries keep markets focused on details like origin, classification, and product codes. At this juncture, U.S.-specific contract delivery certifications become critical, requiring written confirmation from authorities. Without such clarity, the carrier warehouse insurer network remains on hold, sustaining market stress. Switzerland's diplomatic response also carries weight through trade channels, given the gold sector's pivotal role in its precious metals industry. If country-specific U.S. tariffs are enforced at high rates, negotiations for exemptions between Bern and Washington will be unavoidable, leading to anticipated trade delays. Which bar? Which origin? Classification shapes pricing. Such delays will influence delivery preferences across financial hubs, prompting the market to seek new connections within the London-New York-Zurich triangle. While terms like good delivery may sound technical, they are central to the physical requirements of U.S. contracts, shaping trade confidence. Companies wrestle with questions about product codes and casting standards within this framework, and market pace hinges on these documents. In short, diplomacy matters because a minor tweak in U.S. gold trade language can create substantial cost differences. The most efficient solution for authorities is to reduce market uncertainty with a clear, simultaneous statement. How tariffs affect consumers, jewelers, and investors. The most common question from U.S. jewelers and investors is how these tariffs will impact consumers. In the short term, retail outlets will tweak their pricing based on market trends, making incremental dollar adjustments. Over the medium term, jeweler inventory costs may climb in U.S. accounting, and combined with tariffs, profit margins could shrink. For electronics manufacturers, gold represents a small but vital component cost, and trade plans shift if U.S. delivery delays persist. If this disruption spreads, it triggers a secondary pricing wave with reduced but costlier supply. In tight credit conditions, U.S. consumers grow more price-conscious, increasing deferred demand. If delays become permanent, retail sales may decline, eroding market confidence on the economic front. Why 1 kilogram bars matter in trade terms. Let's clarify why 1 kilogram bars are significant in trade language. U.S. contracts frequently involve this class due to its standardized weight and purity, which streamline delivery and enable arbitrage. If this class faces tariffs, the most liquid transport unit becomes a bottleneck, inflating trade costs. This isn't just a price increase, but a time loss for the U.S. market, reducing flexibility. When flexibility wanes, alternative routes are explored, but costs for transport, storage, security, and insurance rise in dollar terms. These rising costs spark new negotiations between jewelers and producers, with U.S. discussions focusing on cost sharing. Such terms are embedded in trade contract footnotes, easing market tension. Good delivery standards and U.S. contract clarity. Ultimately, the White House's signal to clarify the issue curbed panic on U.S. trading screens, but written confirmation remains vital for trade stability. If an executive order specifies which bars, origins, and rates are affected, the future spot spread narrows, and U.S. delivery chains stabilize. Persistent uncertainty, however, reinstates the cycle of grounded flights, costly insurance, and full warehouses, driving up trade costs and prompting market reactions. Professionals in the U.S. are quietly discussing the possibility of a policy reversal, preparing trade accounting accordingly. Even if reversal seems unlikely, mechanisms like excess collection refunds could mitigate market impacts. Without such measures, the divide between jewelers and investors widens, and trade is perceived as costly and complex. Switzerland's role and market sensitivity. This perception leads to delayed purchasing decisions among middle-class consumers, shrinking market volume. Switzerland's influence in the refinery logistics finance triangle makes its gold trade relationship with the U.S. highly sensitive, and the market recognizes this. A single sentence from U.S. authorities can spark weeks of trade debates, altering market dynamics. If both parties swiftly agree on the scope, duration, and exemptions in writing, the U.S. market can return to normal, lowering trade costs. Otherwise, sourcing from alternative hubs will emerge, and markets will factor in origin risks. Higher origin risks mean U.S. contracts will demand more frequent collateral updates, requiring traders to reserve additional cash. This cash allocation pulls savings from other sectors, triggering a broader economic slowdown. Economic ripple effects and investor strategy. This slowdown dampens investment enthusiasm in non-financial industries, pushing markets into a defensive posture. From investors' perspective, the disciplined approach is to prioritize procedure over emotion, a principle rooted in U.S. trading practices. Jewelers should avoid excessive inventory risks during price surges, while fund managers must strengthen collateral oversight. For refiners and logistics providers, a wait-and-see strategy can cap U.S. costs and ease market strain. Retail investors should note that local gold premiums in the U.S. may stay volatile, with trading costs exceeding typical levels. Monitoring the price spread time dynamic is essential, and markets are interpreted through this lens. The need for clear U.S. policy. The fastest resolution lies in clear statements from Washington, where U.S. regulatory language is primed for this purpose. Once clarity on product origins and classifications is provided, trade flows stabilize. To summarize the broader picture, the U.S. public expects a clear framework, and trade decisions hinge on this. When terms like country-based tariffs are applied to a global commodity like gold, markets split into futures and spot segments, and logistics falter. A same-day clarification note can quell panic on U.S. screens, allowing traders to adjust plans. Without written clarity, volatility persists, amplifying impacts on U.S. consumers. With a clear statement, jewelers, electronics manufacturers, and refiners can resume normal operations, closing an unnecessary inflationary channel and stabilizing U.S. prices. A question for reflection. We pose this question to you, but take your time to consider it. Will Washington resolve this trade uncertainty with a swift correction, or will the tariff debate linger, prolonging market volatility? One final note. The U.S. agenda moves quickly, and trade headlines can escalate rapidly. Our channel will continue to break down such topics in clear, objective economic terms, illustrating their market impacts with straightforward examples. If you share your thoughts from a U.S. trade perspective, it will enrich the discussion and sharpen our market analysis. To stay updated on new videos, subscribing and enabling notifications will ensure you don't miss our immediate analysis when Washington releases its statement. Thank you for watching, and we'll return with a market overview as soon as new developments emerge in the U.S. tariff file. In our next video, we'll explore the impact of U.S. tariffs on non-gold metals, comparing differences in trade chains. The agenda moves fast. Let's stay composed, follow procedures, and analyze markets with data.